You can earn more than you ever imagined and still feel financially behind. And that contradiction often confuses people because on paper the numbers appear strong while internally the pressure seems to increase rather than decline. Imagine someone whose income has doubled over the last 5 years. Their lifestyle has improved. Their apartment is nicer. Their car is newer. Their vacations are more frequent. And yet when they check their bank account at the end of the month, the feeling is not relief but tension. This is the high earner paradox, where income rises but psychological security does not follow at the same pace. The core concept is that income and wealth are not the same system. Income is a flow variable, something that moves through you each month, while wealth is a stock variable, something that accumulates and remains. When income rises, spending often adjusts automatically because human perception recalibrates what feels normal. What once felt luxurious quickly becomes standard. Behavioral economists call this hedonic adaptation, the tendency for satisfaction to return to a baseline even after positive change. In financial terms, this means the emotional boost from a raise fades faster than the structural obligations that follow it. Consider the math in simple terms. If someone earns $60,000 per year and spends $50,000, they have a $10,000 surplus. If their income increases to $120,000 but their expenses expand to $110,000, the surplus is still $10,000. The absolute income doubled, yet the capacity to build wealth did not change. The ratio between income and retained capital is what determines long-term financial positioning, not the headline salary. Many high earners unconsciously preserve the same savings rate they had at lower incomes, which mathematically slows the transition from working for money to owning assets that generate it. There is also a structural layer beneath this. As income rises, fixed costs often rise in permanent ways. Housing upgrades increase long-term rent or mortgage obligations, car payments expand, social expectations shift, professional circles normalize higher spending. These changes create recurring commitments that cannot be easily reduced without discomfort or status loss. What feels like progress can quietly increase fragility, because higher fixed costs require continued high performance. The margin for error narrows even as income grows. Psychologically, high earners often anchor their identity to their earnings rather than their assets. When identity fuses with income, any threat to employment or market demand feels existential. This creates a subtle anxiety that persists regardless of salary size. Wealth, in contrast, reduces dependency on ongoing performance because assets can produce returns independent of daily effort. The difference is not motivational, it is mechanical. Assets convert time into optionality, while income converts time into consumption. If we zoom out to the broader economic system, we see that modern economies are designed around consumption velocity. Credit availability expands purchasing power immediately while pushing repayment into the future. Marketing environments reward visible success rather than quiet accumulation. Compensation structures often rise in tandem with lifestyle cues, encouraging alignment between earnings and spending. None of this requires malicious intent. It simply reflects how growth-based systems operate. The result is that high income alone does not move someone outside the economic engine. Only retained capital does. The shift, then, is not about earning more or spending less in isolation. It is about recognizing the threshold where surplus begins compounding independently of personal labor. A 10% savings rate at any income level produces gradual change. A 30 or 40% savings rate fundamentally alters the time required to build financial resilience. The math becomes nonlinear because investment returns begin generating their own returns. The earlier that retained capital reaches a meaningful base, the less dependent future stability becomes on future raises. High earners who feel broke are often not mismanaging money in dramatic ways. They are participating in a system where lifestyle expansion mirrors income expansion. The solution is not austerity or withdrawal from modern life. It is structural awareness. When income increases, consciously preserving or increasing the savings rate changes the trajectory. When fixed costs are chosen with flexibility in mind, volatility becomes less threatening. Over time, wealth accumulation shifts from being an abstract goal to a measurable buffer. Feeling broke at a high income is not a personal failure. It is usually a mismatch between flow and stock, between earnings and retained capital, between identity and independence. Once that distinction becomes clear, financial decisions begin to reorganize themselves around durability rather than display. Income may start the process, but only accumulated assets change the underlying mechanics. And when that shift occurs, the feeling of scarcity gradually gives way not to extravagance, but to quiet stability.